Hello, everyone, and welcome to LPL Market Signals. Jeff Bookbinder here with part two of our 2025 Midyear Outlook presentation. Of course, last week you heard from myself, Jeffrey Roach, and Lawrence Gillum. We talked about stocks, bonds, and the economy. Next up, Christian Kerr and Adam Turnquist to talk about commodities, currencies, and alternative investments, which I guess pretty much rounds out the whole publication. So thanks, guys, for joining. Hope all of you had a good weekend. It is Monday, July 14th, 2025, as we're recording this. And here you see, hopefully all of you had a chance to look at the Midyear Outlook publication recently released. You can find it on LPL.com, Pragmatic Optimism and Measured Expectations. So I guess, to start with alternative investments, Christian, I guess measured expectations is one of the reasons why it might be worth thinking more about alternative investments than you might otherwise, because they tend not to be high return instruments that are going to keep up with the big rally. But if this market sort of settles in at about where it is now, or just sort of grinds modestly higher, then you would think alts could keep up. So why don't we start there with alts in terms of what they can offer a portfolio, what types of alts do we think make sense, and I'll turn it over to you.
Yeah, thanks, Jeff. Again, good to be here. Yeah, I guess we go to the next chart. That's I think that sums up a lot of kind of why we think the way we do about alternatives. But uncertainty and more specifically policy uncertainty was clearly the main theme of the first half of the year, and I think this chart shows that well. So in looking out over the next 6 months, we're sitting here thinking policy uncertainty probably continues to hang over the markets, at least to some degree. To start the year, the equity market was really set up for Trump 2.0 to be a carbon copy of 1.0 in terms of policy, and it clearly wasn't. And I think that realization was really at the core of all the volatility that we've experienced. And then this pivot back to something a little bit more normal in terms of policies was, kind of behind the swiftness of the recovery that we've been seeing as well. So, we think we're probably past peak levels of policy uncertainty as the market understands now that Trump 2.0 is going to be a little bit different. We also recognize that the more equities rally, the more room that kind of creates for the administration to try and pursue some of its longer stated goals on things like trade, and we're already starting to see that with the ramping up of some of this trade rhetoric following the passage of the big beautiful bill. So bottom line, we think this is going to lead to episodic bouts of volatility over the next few months, and investors should be prepared for that. But we also think there's a good chance, the administration will pivot back towards something that's more clearly pro-growth, pro-market, as we start to get inside kind of that 1 year window inside the midterm elections. The S&P is basically society's mood barometer, and they probably won't want to risk it coming under too much pressure heading into midterms, as it reduces the chances of holding the majority. So from a portfolio standpoint, the question is, how do you position portfolios to weather volatility, but also set them up to take advantage of new opportunities that we see kind of emerging on the other side of all this? And from a big picture perspective, we think the answer lies in really emphasizing diversification, so being well diversified across asset classes and geographic regions, and integrating things that can help enhance portfolio stability. So we move to the next slide, Jeff. Certain alternative strategies are historically uncorrelated to stocks and bonds that can help portfolios be more, we call all weather. So in our view, alts are an important piece of that puzzle, just in this environment of higher uncertainty. If you boil it down, risk in a portfolio is really just what can hurt you if it happens. For most people, that's high volatility, and volatility is really just a reflection of sudden change. So, how do you mitigate that risk? We think you do that by incorporating things into a portfolio that can actually benefit from change. So things like real assets, managed futures, discretionary macro strategies, they can all be potential sources of uncorrelated returns when you need them most, and kind of help provide that all-important ballast to a portfolio. We like to say hedge when you can, not when you have to, and we think these strategies kind of allow you to do just that. We also think diversification within alts is essential, as each strategy kind of brings different characteristics to a portfolio, and kind of this chart shows that here. So really having that right mix is important. Something like managed futures is good for limiting drawdowns over full market cycles, but won't do as well in environments of brief and intense volatility, kind of like we just had. So things like discretionary macro and explicit long volatility do better in those types of regimes. So again, being diversified in alts is hugely important, and we think kind of just having that mix in portfolios, over the next kind of 6 months to a year is going to be important, just given that we still foresee uncertainty kind of being being a big overhang for the markets in the immediate future.
And so, Christian, when you talk about discretionary macro, you're talking about, not just buying a basket of stocks globally, you're talking about playing commodities, currencies, really all types of different investments, right? Is that what the discretionary and macro really means? They can go
Yeah,
anywhere and they go both directions.
yeah. Discretionary macro manager will be trading, investing in, and basically, a wide variety of markets. Currencies, are a big part of that. Stock index futures, things like that. And like you said, Jeff, yeah, they can go long and short. So they kind of bring in these diversified income streams, and they did well because they were because of that discretionary element last year, last kind of over the last 6 months, to where they're not rules based like the managed futures strategies are. So they could kind of take advantage of some of these extremes in volatility that we saw kind of a little bit better because of that discretionary element. So yeah, I would say because they have the flexibility to trade in so many markets, that's kind of what brings that lower correlation to things like stocks and bonds, and that can be a real benefit when you get into a market environment that is highly volatile, like we saw in the you know end of the first quarter, beginning of the second.
Yeah, we in LPL Research are putting our money where our mouth is. We're actually using alternative investments in our model portfolios. So certainly like that cushion or ballast, if you will, a place to go for maybe calmer waters if the sea gets choppy, which it certainly could. By the way, this starts, I think, the weakest 3-month period of the year for the stock market. So with this S&P still being right near all-time highs, maybe a good time to think about hedging, as you said, Christian. Hedge when you can, not when you're forced to. So thanks for that, Christian, overview of alts. Again, that's a section in our Mid-Year Outlook. Great job by you and Gina, you and our chief alt strategist, putting that together. So Adam, you're up next on commodities. We've titled this section Mixed Results Amid Messy Macro Backdrops. There's that macro word again. It certainly has been messy with a lot of, we'll say, cross currents with trade and tariffs, as well as certainly geopolitical risks. So um, first up, I guess, is a broad commodity chart. What is this telling us? The Bloomberg Commodity Index.
Thanks, Jeff. Happy to be here. And if you look at this chart, it doesn't really do the first half justice. It's just this range-bound commodity market. This is the Bloomberg Commodity Index. It did beat the S&P 500 by a couple tenths in the first half on a total return basis, but there was a lot going on in the commodity complex as we highlighted that messy macro complex. We had tariffs implemented with steel and aluminum, then we had more tariffs with reciprocals, those were paused, the dollar down double digits. So a lot of volatility within the commodity space, but a positive first half. Now, don't hold your breath for another second half of outperformance over stocks. It's only happened about a handful of times since the early 1990s, where the Bloomberg Commodity Index actually outperformed the S&P in the first half and the second half. When we look at things technically, I think we have to give stocks the edge here in terms of their relative performance and momentum, but there's still opportunity here in the commodity complex. We like precious metals. We have, at least for the last year now, gold's been a big story, outperforming stocks, not only just last year, but over the first half as well. Pretty good setup from a catalyst perspective for gold. Silver also joining the party, breaking out this recently in the last few weeks here to multi-year highs, benefiting from not only the prospect for some potential trade deals and maybe a boost in economic activity, but also that weaker dollar, which has been a big story here for commodities. When you look at the broader complex here, just technically, really need to see a clear close above 109. That might start that super cycle rhetoric that we heard maybe at the beginning of the year, where commodities are the broad commodities complex firing in all cylinders, but we're still just range bound for now.
Yeah, I know, Christian, you've been following copper. We got a pop there on that tariff situation. What what impact do you think tariffs broadly will have on commodity prices? Any sense of that?
Yeah, I mean, I think we've been seeing it a lot through the first half of the year with kind of this, for lack of a better word, front running of tariffs. So you've been seeing a lot of uh, divergence between commodity prices in the U.S. versus commodity prices in other jurisdictions. So I think it becomes very specific to the commodity. Copper, as you mentioned, Jeff, has been, trading very, very differently kind of in terms of the spreads versus the rest of the world. And that's a direct reflection of these tariffs. So I think the more we kind of see that, the more dispersion we probably start to see within the commodity markets. I mean, I think if you look at commodities more generally, if you take out precious metals, they've almost been in a downtrend because of energy is such a big component, and it's been highly volatile, but mostly on the weaker side to start the year. So I think to see a broader commodity move that kind of takes the complex higher. You need to see a few things. I think China, as Adam mentioned in the mid-year outlook, is incredibly important. We've been waiting for this recovery. It seems like forever. So I think that's a big aspect here. And then I think the dollar, right? The Adam will mention, I think, coming up in a few slides, but the tailwind of a weaker dollar tends to help commodities, and we're kind of on critical levels there. So if we were to see kind of more clear evidence of a dollar bear market here starting, then that kind of helps broader commodities as well.
Yeah, that China story will be big, obviously. We did get just over the weekend an improving outlook, at least on their export activity, better than expected. They actually had really good crude oil imports. They're the world's largest importer of crude. So maybe early signs of some economic traction there. They've thrown a lot of stimulus at their economy, just haven't really had much luck or traction in terms of
Mhm.
that growth outlook over in China.
Yeah, trying to stimulate their property market, making some progress, and that has caused markets to move a little bit. I'm not sure that's a huge driver for gold specifically, but here's a chart, Adam, that you wanted to highlight for gold in terms of its relationship with rates.
Right. So this looks at gold in dark blue and then real 10-year yields. So we're looking at yields adjusted for inflation, but we're inverting it just to show the relationship a little bit easier. So when that orange line is moving higher, that's real yields moving lower. And as you can see, going back to or really coming out of the global financial crisis, the two moved in tandem. Lower real yields meant higher gold and vice versa. And that was a pretty consistent relationship really up until couple of years after the pandemic. You can see in 2022 that started to unravel. You had real yields moving higher, but yet gold also moving higher at the same time. And the big question is, why did that relationship break down? And as we highlight here, it was really centered around when Russia invaded Ukraine and the Western countries started to seize Russian assets. And a lot of those were central bank reserves, somewhere in the tune of 350 billion apparently. And that started to a lot of central banks started to rethink how they want to hold their reserves, and they started holding more gold. So you can see gold moving higher as real yields also were moving higher. It's not just the seizing of Russian assets. Of course, we had an elevated geopolitical environment, so gold as a safe haven worked. We had the dollar weakening a little bit as well, at least more recently on this year, at least for the dollar. So there's some other catalysts. This year, we also had a return of ETF physical gold demand that was really missing last year. There's this fear of missing out rally kicking in on gold after it started to break out. That's been apparent. We had 5 straight months of inflows into those gold ETFs. So there's quite a few catalysts for gold, but I think one of the big ones has been that change in the narrative coming out of the Russia-Ukraine war.
Yeah, gold has several different drivers. You alluded to all the big ones, Adam. It's it's tricky to know which driver is going to matter at which time. And so clearly, for those thinking that rates would matter, obviously in the last few years I was wrong. It's been more about, like you mentioned, the central bank buying and certainly the geopolitical angle with the weak dollar has been a part of it too. So good insights there. Certainly still a positive view from our team on precious metals. Actually, that brings up another question. Christian, you talked about alts, and if you have alts exposure, you might have managed futures. Would you think you're doubling up if you have an allocation to manage futures and an allocation to commodities? How should people think about that if they want to carve out a small piece of their portfolio, perhaps to both?
Well, remember, managed futures can go both long and short, right? So they might be short commodities. So if you were to invest just in real assets, you're taking a long only bias. But there are obviously many times where there's some very important trends in the commodity market that are on the short side. So I think that's the big difference. And it's also, because they're trend following in nature, they'll tend to be kind of getting into commodities when you want them as well on the long side. So I think they kind of give you that exposure that you might want or need at the right time. So, they're similar, but they're different as well because of that ability to go short.
Yeah, so view them as separate asset classes is what you're saying.
Yeah,
Which
or at least different enough where they're worth having both in a portfolio over if you have a strategic kind of perspective.
Thanks for that clarification. All right, so next up on the commodity front, this chart, I think, Adam, requires some context. People are trying to add up the bars. They
Yeah, well,
actually add up to 200, not 100, if I'm not mistaken. So what are we
yeah,
showing here?
you have dollar and gold, so there's two different data points that we're
Yeah.
discerning between. But yeah, there's a lot of colors and a lot of numbers. So I can break down the data in a simple story. If you go back to 2021, this is from the World Gold Council. Every year they do a survey among their central bankers, and they ask them, what are your expectations for gold reserves, dollar reserves, and then they post it. So you can see 2022, in terms of how many were looking at increasing their gold reserves versus unchanged, lower gold, and the same for the dollar. And the short version of the story, without getting into all the data, is that there's been an overwhelming response from central bankers that are, one, going to increase their gold reserves. And the most recent data showed, I think, over 80% were planning to increase their gold reserves to some degree. And also, two, they're going to decrease their dollar reserves. So that trade, or that increase in central bank buying, that theme could continue for several years. This is looking out over the next 5 years, according to the central bank survey. You can see it in the data. Central banks have added over 1,000 metric tons per year since 2022. That's over double what they were adding post global financial crisis for the decade leading up to that. So there's been a tremendous amount of central bank buying, and it's not just one or two central banks. It's been pretty broad based in terms of who's buying as well.
So they're actually doing what they say they're going to do. I think that's one takeaway here.
Yeah.
But also, you're basically just going up, 10 points a year on dollar bears and gold bulls. I think that's probably an easy way to explain what's going on here. It's also interesting, and Christian, you flagged this. We've actually seen rallies in platinum, and I think palladium even made a move. Like some of these other precious metals we mentioned, silver. Uh, Maybe central banks are even diversifying beyond gold here into other commodities.
Yeah, it's not historically unprecedented, right? Particularly in the era prior to 1971 when the dollar went free float, to hold kind of a basket of other metals. But I do think with gold getting to levels on a relative basis that are undeniably expensive, it is something to be kind of on the lookout for. Are some of these central banks, particularly the ones that Adam was highlighting, post the Russian invasion, kind of who were moved to start looking for other areas to diversify? Do they start looking at kind of some of these cheaper metals? We haven't seen evidence of that yet, but I think it's a very real possibility. I think the other big thing to be watching out for in terms of reserve trends is going to be, this has mostly been driven by by kind of Eastern Hemisphere central banks. The West hasn't really, taken part in this in this diversification trend to a large degree, but you can make the case that that they probably should be thinking about at least allocating some more reserves in the gold. So I think that's something to be looking out for kind of over the next few quarters, as well as whether kind of the Western central banks start moving a little bit more into gold and potentially other precious metals as well.
Yeah, I guess it's, some of our allies are maybe a little frustrated with us in terms of trade negotiations, but I don't think any of them are going to try to seize the Federal Reserve's assets. So we're not gonna have to worry about that. So thanks for that color, Christian. Really interesting stuff. This is a natural segue, right? Because we were just talking about the weaker dollar in that survey from central banks, and certainly, Adam, a lot of people think the dollar is going down. In fact, I believe that the latest Bank of America survey had something like 92% dollar bears in it. I mean, it's maybe folks are on, all on one side of the boat, and that could tip us the other direction. What do you think?
It seems to be in the other side of that trade, I think, and that maybe the same survey data is long gold is the most crowded trade on the
Well,
bullish side. So naturally, right? But you can see the dollar, and I think this is a good way to frame it up in terms of time frame and why it's important. This is a multi-year weekly chart of the dollar. On a short-term basis, we're starting, we'll call it early innings of a potential breakdown from the lower end of this channel the dollar's been in really for the last few years, kind of right around 97, 98 is the lower end, 105, 107, we'll call it on the upper end. And that's where the dollars existed during the last few years. We started to see the dollar break down, basically a one-way street for the dollar since January, breaking through some of those early levels, but very, very oversold here on a shorter term basis. Sentiment extremely bearish. I would call it at contrarian levels. You can see that in the positioning data on the bottom. That's total speculative dollar positions in red, implies they're short. So it's a crowded trade on that side. And now we're at a key support level when you look at this secular uptrend that's been in place going back to 2007, 2008, those lows. And when you compare some of these prior drawdowns with the dollar in the, call it 12 to 15% range, since it really broke out to new highs, cleared the '09 highs, that's kind of where we're at right now. So it's going to be a big inflection point. We'll see if we get any type of relief rally. I would not be surprised to see a bounce here in the dollar off this longer term uptrend. And I think that's going to dictate performance in the second half or a big driver of performance in the second half for international versus US. I know this is a chart we're watching very carefully technically for any signs of a breakdown. Now, if you do break that uptrend, I don't think it's the end of the world or the dollar's demise in terms of its world's reserve currency. Maybe you get back down to 89 or 90 on the dollar index here. And it's really about the rate of change and how you get there. If it's a slow grind lower in the second half, I think that's a little bit more tolerable for investors, less less of a signal of economic weakness and less concerning in that regard. So we'll see what happens. It's certainly going to be an interesting chart to watch here as we progress in the second half.
Yeah, I could see this. I mean, currencies don't typically move 10%, but
Yeah.
I mean, this just did. I could see it going back up 10% or breaking down and maybe making a downward move uh close to that. That'll be maybe one of the most important charts to follow in the second half. You mentioned, Adam, about reserve currency status. A lot of people have been worried about this. I think if somehow the Trump administration finds a way to get Chair Powell to quit or fire him, we might see a little bit more of this talk about the dollar losing its reserve currency status or just falling dramatically. We don't think that'll happen, but it's certainly something to think about, and it's in the news every day. What does this chart tell us about how likely the dollar is to kind of stay king?
It's pretty tough for someone to dethrone the dollar in terms of its world reserve currency status. And that's the point we're trying to make here. Even though the dollar had a very rough first half, down double digits, one of the worst first halves the dollar's had, it's still very much the world's reserve currency. You can see its use case with just the percentage of international transactions, basically in half of them, according to the SWIFT data, So it's heavily involved in trade around the world, and it's also the most owned asset in terms of world reserve currencies. That here you can see 58%. That number's come down a little bit, as we alluded to earlier, with more central banks buying gold, diversifying away from the dollar. But the nearest competitor is a long ways away. The euro, I mean, this is when some of these headlines really came out when the euro came, I think the late 90s, 1999, about that could dethrone the dollar and be the new world's reserve currency. It hasn't really made a lot of progress. Only about 20% of central bank reserves are in the euro. And when you think about the qualifiers to be a reserve currency, some countries check a few boxes, but not all of them in terms of our deep liquid markets, not only in the equity space, but the fixed income space. We have relatively stable fiscal and monetary policy, a regulated market as well. So there's quite a few competitors, but they're a long ways away from actually making material progress in terms of dethroning the dollar in the reserve currency status.
Yeah, I mean, if the euro is going to take over, it's probably got to have more in central bank reserves than gold does. And Christian, I learned this from you that reserves of gold have actually passed the reserves of euro.
Yeah, just recently. Yeah, and just to echo Adam's thoughts. Yeah, I mean, the things that you need to become a reserve currency that they just don't have. I think one where they're trying to address it now would be on the military front, right? It's basically been, the U.S. essentially through NATO, which is providing that security, but that's a hugely important aspect for being a reserve currency. Maybe China has that. China probably checks one box, but it's funny to me that any time you see kind of weakness in the dollar, it's supposed to mean that the reserve currency status is coming under threat. And I think it's completely normal to go through cycles where, the dollar weakens, and it doesn't necessarily mean that's happening. I think just over the last kind of decade plus, we've gotten used to just the dollar, being extra stable and generally moving higher. But if we were to go into a period where it weakens, it'll have a lot of portfolio implications, but doesn't necessarily mean that the current system is under threat. But I'm watching it very closely. That chart that Adam highlighted. If we were to break that, that starts to have implications in terms of international equities. Typically speaking, emerging market equities tend to do very well when you're in a dollar bear market. From a U.S. perspective, sectors within the U.S. tend to, things like materials can do very well during periods of a dollar bear market. So that's more what I'm looking at here in terms of this dollar inflection point that we're at, because that is going to have a lot of implications for what it means for portfolios if we are indeed in a dollar bear market of multi-quarter, multi-year kind of length.
Yeah, it's nice to at least have benchmark level exposure to international equities and emerging market equities, just in case you get this, further downside move in the dollar. So we're getting diversification with currencies and with regions, as well as your typical sector and style diversification that we talk about a lot of the time on market signals. So thanks for that, Christian. Really interesting. So last chart on currencies. So this, Adam, you put together. It is showing how I guess U.S. stocks and international stocks do in other currencies. So this is a big, dispersion. I don't know if it's a record, but it's a lot of dispersion between international markets in dollars versus their local currency.
Yeah, some pretty big gaps here in performance, and probably an underappreciated component of the first half returns, at least by me. Even though I watched this daily and knew there was, the dollar was trading lower, I didn't realize that the gap in performance was really this much for the first half. You can see if you just bought the S&P just with the dollar, you're up 5%, just over that in terms of total return. If you bought the MXEA, which is IFO, or International Developed, the benchmark there, in euro, 3.6%. Where it really goes in terms of performance gaps is when you buy IFA and the dollar, that's 17%. Or if you're the unfortunate international portfolio manager, unhedged, and you bought the S&P in euros, you'd be down about 7% this year. So there's some huge gaps in performance. And if you flash back really the last decade or so, if you look at hedging ratio, so how much an international investor hedges their U.S. positions in U.S. equities. They've gone from about 50% hedged up until 2020 to call it low 20s or high teens type hedging ratios, because the dollar traditionally acts as a safe haven. And what we witnessed in April, the dollar traded lower with equities, those correlations started to break down. So not only did an international investor underperform going into Liberation Day, they did not get that bounce in the dollar, the safe haven bid in the dollar. I think it has likely ramifications for increased hedging ratios in the dollar as we look at the second half. That could put some added pressure on the greenback as well as they hedge out those positions in the forward market, which implies dollar selling. That's what the evidence is starting to show. We'll see how much that plays out. Maybe we get a rebound here in the US and we get some dollars coming back into the US with big tech starting to work and the mega cap names starting to work. Maybe that's going to be the second half story, and we'll see if we can play catch up here domestically versus the international developed space.
Yeah, there's so much opportunity for global asset allocators to make good calls and potentially, add outperform. It can go the other way, but there's absolutely a lot of potential for outperformance by getting these currency moves right or these regions right. You can see it on this chart, right? A 24-point gap in the first half between S&P unhedged and EFA unhedged, I guess, if you are a U.S. investor buying EFA. So really important concept. So thanks, Adam, for that. At this point, I think we'll wrap. Next week, we're going to go back to kind of our normal agenda, I guess you could say, with the, kind of recap of the prior week's market action and then a preview of the week ahead. But certainly this week is a big week with CPI and retail sales on the economic calendar, and then earnings season. We'll have a lot more to say about earnings next week. So please tune in for market signals next week. Thank you so much, Christian. Thank you so much, Adam, for walking through the back half of the mid-year outlook. I guess we covered every section except one, which is Washington policy, the Washington outlook. But we will do that probably most weeks going forward because there's always plenty to talk about in Washington. So thanks for checking out Market Signals. Appreciate your support. Everybody have a wonderful, wonderful week, and we'll see you next time.
See you later.
Thanks.